Good afternoon, everyone, and welcome to our fourth town hall of the year. It is really hard to believe that we're already at the end of October. We are 10 months through 2025 and heading very quickly into 2026. And yet here we are again for the fourth time this year, gathering to reflect and take a look ahead at what could potentially be occurring, in our last few months of this year, but into 2026. On behalf of all of us here at the Wealth Stewards, I want to sincerely thank you for joining us today. It's these sessions, these town halls, they are for you, and we really hope that you continue to find value in this time that we spend together. At the conclusion of our remarks, we want to hold all questions until then. We're going to open the floor, though, to any and all Q&A that you might have. If you're looking at home, on the bottom of your screen there, you're going to see a chat feature. Type any questions that you might have. If it's something we're talking about, something you'd like to hear us address, please put that in the chat, and hopefully we'll have plenty of time to address all those at the end. Think about the questions that matter most to you, to your families, to your businesses, things that you want to hear us address. If we don't cover something that you want more detail on, please put it in the chat or email us directly. So now as we sit here at the tail end of the year, it's natural to take stock of what we expected for 2025, what surprised us, and what things might look like as we move into the new year. At the start of 2025, there were a few things that we could reasonably anticipate based on history. First, we had a sense that the Federal Reserve was likely to move toward an easing posture. Chair Jerome Powell has been excellent in terms of telegraphing what the Fed is going to do, where they're headed, and the data supported that we might see a few rate cuts this year and some modest easing. What we didn't expect was the degree of the trade noise. We expected tariff talks for sure. We expected negotiations. This is, after all, Trump administration. We saw something very similar from 2016 to 2020. And we had that pattern again this year. But the surprise for us, I think, was the abruptness of some of these moves, especially following Liberation Day back in April. That kind of took us by surprise a little bit. Then there were some other developments that caught nearly everyone off guard. First, we had the US dollar. I don't think anyone really expected the dollar to weaken as sharply as it had in 2025. In fact, this has been the worst year for the dollar since the 1970s, and it's really been a defining story for this year. This shift, this dollar weakness, has had far-reaching effects on global asset performance. And for those of you that are clients, you've seen it reflected in your portfolios as well. We've had plenty of geopolitical news this year. We saw renewed tensions in the Middle East, particularly between Israel and its neighbors. The United States actually carried out airstrikes in Iran, something that we were not expecting heading into this year. Add to that ongoing disruptions into global supply chains. Russia-Ukraine is still simmering. And if you had told me back in January that we would have this level of tension in the Middle East and in Eastern Europe, and yet oil prices would somehow remain as well behaved as they have, I would have been surprised. And yet, here we are. Energy markets remain consistently low despite all of these headlines. But all these things, all these news stories, it reinforces something we talk about a lot here at the Wealth Stewards. It's a durable portfolio design. It means preparing for these unknowns. We really cannot predict every event, but we can build balance, resilience, global reach into your portfolios so that we can live through these expected and unexpected conditions and hopefully profit fairly well in the meantime. This year for sure has tested that philosophy, and so far our philosophy is it's been a good year overall, and we're looking forward to sharing some numbers with you. So let's take a look at the agenda, Chris. So here's what we've got planned tonight. We're going to start with Ryan and Cyrus. They're going to walk us through what's happening in interest rates and what potentially lower rates could mean for both the economy and your portfolios. After Ryan and Cyrus, I'm going to hop back on. I'm going to give a couple brief things that I think are really driving the markets. One is that weaker US dollar that I alluded to before. The second is the significant increase in money supply and what that's meant driving liquidity in the United States and around the world. I think these 2 points will answer a lot of questions about what's worked in your portfolios this year and maybe even importantly, why it's worked. Then we're going to hand things after that off to Kayla. She's going to talk RMDs and your retirement accounts, specifically what the distributions are and recent rule changes that might affect many of you. Now, I'm going to say in advance, don't worry about it. We got it covered, but we just want you to know what some of those changes might be. After Kayla, it's going to come back to me one final time. We just completed a 9-month project to build our new website, and I want to take a few minutes to show you what's new, how we're using it now, and how we hope to use it as a client resource hub. And then finally, we're going to wrap up with your questions. As always, we want this to be as interactive as possible, as meaningful, all of you that are joining us. And so with that, thanks again for being here tonight. I'm going to turn it over to Ryan and Cyrus, who are going to kick things off talking about interest rates.
Awesome. Thanks a lot, Brent. We've got no shortage of things to talk about with you. There's a lot going on, so we figured we'd start with the most boring one, interest rates. So To get that started, I just wanted to give you a quick rundown, walk down memory lane of this last rate cycle. Most rate cycles aren't memorable. This one will go down as being quite memorable. And this is going to be framed by Chairman Powell. So this started really with COVID. Rates got effectively down to zero. And then the famous last words of the inflation would be transitory. So um, in April of 2021, Chairman Powell said, don't worry, this inflation you're seeing, it's going to be very temporary. Everything's going to go back to normal. By the end of 2021, he was tired of getting roasted for how wrong he was with that. So if you recall, regular dinner that may have cost $50 all of a sudden was $150. So walk back the language of this being transitory and moved in March of 2022 to the fastest rate hike cycle in history, plateauing in September of 2024 before they started doing cuts last year in September. Chris, the next slide. And so what this chart is showing you here in the yellow, you're seeing what rates look like, the yield curve going back last year in September, and then in the dark blue where we're at through September of this year. So what you're going to notice is the front end of the curve has come down dramatically, but the long end hasn't, and it's actually increased, which is unusual. But we're coming out of an unusual rate cycle where we had interest, the yield curve was inverted for a long period of time. So how does this impact the shorter term instruments? Basically, the Fed controls the very front end of the yield curve. So when everyone talks about rate cuts in the Fed and if they're going to do anything, and Jerome Powell being late again, you saw yesterday that we had another rate cut and the market reacts immediately on the front end of that curve. So you're seeing money markets and things like that immediately reacting to those cuts. But the longer term bonds aren't going to have that same immediate reaction. It's going to take a little bit longer. But the thing that's interesting there is for bonds in general, how that's going to impact your bond portfolio. As rates are going down, you typically see the net asset value price of those bonds increase. So it's a net positive for bonds. That can be counterintuitive. But we wanted to point that out and also just kind of show you what's happening with this normalization with the yield curve. And then on the next slide, we're just going to talk about what forward-looking expectations are, kind of walked you through where we've been and now where we're headed. So the expectation dot plot from the Fed, if you're really bored in your life and you're looking at economic reports, you've seen this. Hopefully you've never seen this. But what we're expecting is rates are going to normalize close to around 3%, and that could happen as quickly as next year. But what you saw yesterday, Chairman Powell kind of walked back. It was a foregone conclusion we would see another rate cut in December, and he said not so fast. And you saw the market kind of sell off on that news, not heavily, but a little bit into the close, down again today on that. And overall, what I'd say to that is, this is not, he's not signaling that we're done with cuts. And that's the most important and most critical thing. He's saying it's a coin toss, basically 50-50 chance in December we get cuts. That's what we're pricing in markets now. But we had a 90% expectation for a cut in December. So that's the reason for the sell-off. But again, he's left the door open for more cuts, and we would anticipate more cuts into next year. That's the boring side of this. I'm going to let Cyrus tackle the stuff that actually matters to you, how this is going to impact you and your portfolios.
Thank you, Ryan. I'm biased, but I don't think that was all that boring. So thanks. Hi, all. Again, I'm Cyrus Baravati. Ryan just gave us a really good synopsis of the general state of this Fed rate cut cycle and interest rates as a whole. I want to talk a little bit more about how this impacts you directly. So first, we're going to start with the impact on debt, on borrowing. And the first up here is mortgage rates. So often we hear people say, well, the Fed's cutting rates, so that lets me refinance my existing mortgage into a lower rate. As Ryan alluded, mortgage rates aren't tied to what the Fed is doing. Mortgage rates are tied to longer term yields. Since those really haven't come down, and in fact, as Ryan showed, have gone up, we haven't seen much of a move yet in mortgage rates. The general expectation, is that we'll start to see longer term rates come down, since usually the Fed cutting rates has a cascading effect on longer term rates. But the big takeaway here is that the Fed does not control mortgage rates. That said, it's important for us to know what your current mortgage rates are and your debt side of your balance sheet, because as we might see opportunities, we really want to be able to identify those opportunities for you to refinance into lower rates. The next one here is cash, savings, money market rates. Now, this is directly tied to what the Fed is doing. In 2023 and 2024, we saw some of the best cash returns that we have in over a decade. In fact, it pushed people away from locking in their money in a longer term bond or treasury because they were getting paid more in cash. These rates, these cash rates, have stepped down almost in lockstep as the Fed has cut rates. And if they do keep cutting rates, we'll continue to see these decline. Now, cash and money market dollars were at historic highs, but as cash balances become less attractive, it's important to consider what to do with that money to potentially get better returns. Long-term bonds, on the other hand, are actually seeing higher yields now than we saw a year ago. They're paying more than cash, which we really haven't seen over the last couple of years. So if you're an investor and you're looking to figure out what to do with that cash, what's the time horizon, what's the amount of risk you want to take. But that said, longer term bonds are becoming more attractive. So those with large cash balances should really consider what to do with that going forward. The next one is line of credit. So the most common line of credit is a home equity line of credit. These are generally variable. So these are generally tied to what the Fed does. It's the Fed funds rate plus some spread, or the overnight borrowing plus some spread. So we've actually seen these rates gradually come down as well. I mentioned a home equity line of credit is the most common form of a line of credit, but just know that we also have opportunities where you can leverage, in some cases, your own stock portfolio to borrow off of as a line of credit. We've seen these rates come down. Now, if you're looking to borrow, let us know what you need the money for, the time horizon. That's what we're here for. Again, as I said earlier, to help you access the debt portion of your balance sheet in the most efficient way. But we are starting to see these rates come down. And then the last opportunity here, which is not as common, is the AFR rate. That stands for the applicable federal rate. This is the minimum interest rate that you can charge for a loan without it being considered a gift. This is generally a loan given to a family member, or even with more complex estate planning, selling to a trust, or even other more advanced trust strategies. Similar to mortgages, there could be an opportunity to refinance any family note or more trust notes if we see rates come down more. And so that's really the impact on the debt side. Now the impact on equities. Whether or not we see more volatility in the short term, there's a lot of factors. So interest rates are not the only thing that move the market. But right now it's, are we heading for a hard landing, recessionary, or is this a soft landing where the Fed's cutting rates to ease the economy and have us not fall into too much trouble? But there are generally winners and losers when it comes to falling interest rates. One thing we saw here in the third quarter was, with the expectation of falling rates, the Russell 2000, or smaller US companies, actually outperformed the S&P by over 4%. Again, another reason why we don't just want to put everything in one part of the market. I like to think of smaller companies as like the college student who doesn't have a lot of credit and needs access to borrow, but isn't able to get the best possible rates out there. They're generally more leveraged. So lower interest rates means more opportunity for them to get more debt. That tends to be a larger portion of their expenses, so that helps. So that's just one area that we have seen positively impacted by rates coming down. There's more to it, but I don't want to steal Brent's thunder. regarding the overall market update. But just wanted to point out that we saw certain areas of the market really take hold, such as small cap, as we're looking at what lies ahead with interest rates. And on that, I'll pass it over to Brent to go over an overall market update.
Thanks, Cyrus. And one of the things I want to add to that is, in many cases, our clients may not be thinking about us from a lending perspective, but we do I'm off agenda here, but we do a lot of lending in here. We do a lot of margin lending. We do a lot of securities-based loans. And so, generally speaking, it's shorter term financing to get you from A to B where you need to go. But we're tied into what these rates are doing very, very closely because it does impact a lot of our clients. And I just want to share that if you have some short-term liquidity needs, your portfolios can absolutely be leveraged to access some of those funds. Chris, let's go ahead to the next slide. All right, so a question that I am getting a lot is how come the market keeps going up? Now, there's a lot of really good reasons for that. I think that there's a lot of concern, there's a lot of fear within the economy. But 2 weeks ago, I was in California and I was speaking with a number of private equity managers. And it's a unique conversation to have because these managers, if you look at the number of listed securities, publicly traded companies in the United States where their financials are very public, that's maybe 1 or 2% of the overall economy. But you've got 99% of US companies are private. A full 80% of US companies generating more than $100 million in revenue are private. And so these private equity managers, they're in a unique position because all the financials from these companies are being fed up to them and they see these numbers. And there were a couple of things that rhymed in the conversations I had with them. First, the economy's actually in pretty good shape. There are definitely some rougher patches, but the economy's not in bad shape. You are seeing some unemployment go up, but that's primarily because many of these companies, they're not hiring because the tariff regime is still really uncertain. They also are seeing really heavy adoption of AI that they feel is allowing them to delay hiring some positions. But the numbers that are coming in are not bad. And this is broad-based across the economy, aside from just the big headline companies that you hear about on the news, the NVIDIAs, the Apples, the Microsofts, where all that information is public. But in the private equity space, you're getting a much deeper view into what's happening economically. And generally speaking, it's pretty good. Is it on fire? Absolutely not. But are we in dangerous territory? Based on the data that they're seeing from thousands, if not tens of thousands of companies, the answer at this point is no. But this chart to the left, this is US M2 money supply. And this, to me, says a lot about what we've seen going on in the last couple of years. So what is M2? M2 is essentially the total amount of money circulating in the economy. I want you to think cash, checking, savings, other easily accessible deposits. It matters because this is easy, fast liquidity. And it also matters because if you go back, particularly back to the early 70s, since we got pulled off the gold standard, if you look at, there's a lot of variation year to year, but over time, real estate, gold, US stocks, for example, there tends to be over long periods of time a heavy correlation with what the money supply is doing. And also, as the money supply increases, the financial markets are sort of the path of least resistance for this money to enter the economy. So if you imagine we live here in the Southwest, not all of our clients do, but a lot of us are here. When we get these big monsoon storms like we've had, for sure in the last couple months, hits the mountains, all that water rushes to the low point, comes rushing through. The financial markets in many cases are that low point. So when you look at this chart, what do you see? You see that we are at an all-time record. We have $22 trillion of M2 money. This is at a higher level than we had post the big giant COVID spike. If you remember COVID, just giving money to everybody, essentially dumping it out of helicopters. We get this massive increase in money supply. The markets followed suit. If you see that little dip down, you had a couple things happening. Now inflation's heating up. The Fed's trying to lighten up their balance sheet. They're letting bonds roll off. Money supply is shrinking. If you recall what happened in 2022 in terms of the financial markets, it was a tougher year. I mean, bonds were down, equities were down. There were a couple little pockets of positive returns, but generally speaking, as the money supply shrank, you saw the performance of a number of these assets shrink as well. Well, here we are again. Money supply is ramping up. So I would argue that in terms of the performance that we've had overall for US assets, for sure, it's driven by a couple things. It's the fact the economy is actually okay and doing pretty good, and companies are in pretty good shape. And it's also the fact we've got a lot of money that is still coursing through the system. Let's see that next slide, Chris. The other big story that I think is driving what's happening in the markets and is definitely impacting all of your clients that are clients is that we're seeing the US dollar weaken. Now, this is not unusual. There's been long-term trends where sometimes the dollar gets very strong, other times it gets weak, but this is the weakest performance we've seen out of the dollar since the 1970s. So what does that have to do with investing? Well, those of you that are clients know that in January, just purely based on valuations and a number of other things we saw occurring, we made a big increase in allocation to international stocks. And what that means is all things being considered, even if local terms, if you had a stock that was trading, say, in the United Kingdom or in Germany or Japan, that if the dollar's losing value versus the euro or the yen or the pound, you're getting paid and you're investing in this other currency. It's kind of acting as a natural dollar hedge. So it creates this massive tailwind into these international markets. I had a chart that I was going to pull up, but I didn't. But you could actually go back to the 1960s, and you can see these periods of time where the dollar has been weak and international markets have dramatically outperformed. We're coming out of, until this year, the longest stretch we have had in history of US asset outperformance, meaning when US assets, US stocks and bonds outperform their foreign peers by a lot. And we've been in this regime where we've had a gradually, generally strengthening dollar since the financial crisis until this year, and now we've got a much weaker dollar, and you see that it's been a major tailwind for these international stocks. And again, this is kind of cyclical. It's happened in the past. Kind of tough to be a U.S. only investor from 2000 to 2007. Had a much weaker dollar during that period of time across the board. Great time to be an international investor. From the financial crisis to now, way better to be a U.S. based investor. 1990s, you had a strong dollar. Much better to be a U.S. investor. And for our markets, as great as the markets were in the 1980s, you had the dollar was doing a lot of crazy things. But generally, at about mid part of the decade, the dollar weakened really significantly. Really good time to be involved in international markets. So the two kind of work in tandem together. When you have this weakening dollar like we've having now, and it doesn't seem like there's any signs that that's going to stop. Very good time to be in international equities. And fortunately, this year, sometimes it's good to be a little bit early. We weren't expecting it to realize itself this quickly, but so far this year, being overweight, those international assets have really helped the portfolios. Chris, let's see the next slide. So talk about that dollar weakness, and all you need to know when you see these lines here is that this is kind of happening across the board. So you see, it's kind of really since May or so, you're seeing that line's declining, and that's versus the Japanese yen, that's versus the euro, it's versus the British pound, it's versus the Chinese yuan. So you're seeing it both against emerging currencies and developed currencies, which is again a major reason why you're seeing a tailwind to these international assets. And you couple that with the fact that U.S. assets relative to their peers were just very expensive, and there's some really deep value and some deep historical discounts to be found in these other markets. Those have really been the two things driving return. Generally speaking, in our portfolios, I would argue we're significantly underweight to U.S. equities relative to a lot of our peers. That's in favor of the international assets we talked about. It's also in favor of alternative investments. But we've managed to have this performance across the portfolios that have looked much higher than you would think it would relative to the equity exposure we have. And it's partially because of this big boost in M2, which is impacting, of course, U.S. markets, but also being overweight international assets has been a huge tailwind as well. So with that, now we're going to turn this over to Kayla. She's going to get into probably the most exciting topic of the night, which is RMD. So Kayla, over to you.
Yeah, thanks for giving me the most exciting topic tonight. Hello, everyone. So we are quickly approaching the year's end, believe it or not. It'll be Christmas tomorrow, basically. So as we head towards the end of the year, something that is at the forefront of our minds at the office is required minimum distributions, or RMDs, as we commonly refer to them as. So while they're at the forefront of everyone's minds, I wanted to address a few of the common questions that we get regarding RMDs, and there have been some changes recently as well. So some of you on the call are not in RMD age yet. You're not required to take distributions out of your IRA. So first common question we get is, well, when do I have to start taking distributions from my IRA? This has changed in recent years. In the past, for a long time, it was 70 and a half for everyone. The IRS has since come out with kind of a tiered schedule. So if you were born in 1950 or prior, Of course, you're already taking RMDs. The age in which you had to start was 70 and a half. Leave it to the IRS to throw in that half year in there and make everything complicated. Now, if you were born between 1951 and 1959, the first year you have to take a distribution is when you turn 73. So the calendar year in which you turn 73. If you were born in 1960 or later, your first RMD is when you turn 75. Okay. So, okay, now I'm in RMD age. Next common question that we get is, well, I don't really need or want to take this distribution. Do I have options? So all the IRS cares about is the money actually coming out of the IRA, because then it becomes taxable income and they get paid. They don't care what you do with it necessarily. So of course you can take it out. We coordinate federal and state tax withholding for you out of the distribution. And then if you want, you can just reinvest it into your joint trust individual account if you want it to continue to grow with your assets. It is still taxed. So another option, if you are charitably inclined, is you can do what's called a qualified charitable distribution, or QCD, which basically you can give some or all of your RMD to your preferred nonprofit organization, as long as it's categorized as a 501c3. This makes the IRS happy because you're taking the money out of the account, but you're also not paying taxes on it. It's not taxable income to you. So it's kind of a win-win. How this works, typically we mail a check directly to your organization on your behalf from your IRA. And I will say that when you get the 1099 the next year, all of these distributions will be categorized as a normal distribution on your 1099. So it's really important to communicate with your CPA that you did do a QCD and how much it was and where it was sent. And of course, we are more than happy to help communicate that to your CPA and provide documentation. But if you're just in the habit of collecting 1099s and giving them to your CPA, they won't know that you did a QCD unless they are informed. So just be aware of that. Another common question is inherited IRAs. Say I'm not 73 or 75 yet. I inherited an IRA from someone who was not my spouse. Do I have to take distributions from that account? And the answer is yes. This also changed in 2020 with the Secure Act. So very basically, if you had inherited an IRA pre-2020, you are and were required to take distributions from that account. They were minimal. They were based on your life expectancy, so you could really stretch out that account for many years. The Secure Act came about in 2020, which really significantly changed these rules. So if you had now inherited an IRA, from a non-spouse in 2020 or later, you now have to deplete that account within 10 years. Now, when they first came out with this rule, they didn't really give guidance as to how it's to be distributed within that 10 years. Calculations on per year, how much to take, or we even had some clients skip 1 or 2 years if, depending on their tax situation, it didn't make sense to take income. So a rule that is new to this year, 2025, the IRS is no longer allowing people to skip RMDs from inherited IRAs that fall under the Secure Act. So you have to take something. There is a calculation for that minimum. And then again, you still have to deplete it within 10 years. So this can feel like a lot. It's a lot to keep up on, and in no way do we expect our clients to memorize these rules. There's no test at the end of this. That is something that we handle for our clients, and our amazing operations team, Chris and Andy, they have a solid process in place for not only keeping up on all these rules and regulations, but tracking all of our clients' RMDs, what the calculation is, have they taken it, have they not. And for this year, if you have not taken your RMD yet, you probably already have seen an email from Chris earlier this month, just as a friendly reminder to contact us to get it coordinated. And as we progress further into the year, you will continue to receive those emails and possibly phone calls to remind you to get them coordinated before December 31st. Because remember, there is a penalty if you do not take your distribution, which that penalty is lower than it was in the past. But again, we don't want any of our clients to be penalized for missing their distribution. And again, we're on top of it, but if you ever question where you're at, where you fall, have you taken it, have you not, don't hesitate to reach out to anyone on our team. We all have that information readily available. So that was my super exciting topic, and I will pass it off to Brent with a way more fun topic.
I don't think there's anything more exciting than RMDs, Kayla. So awesome job with that. Thank you. And again, to reiterate what Kayla said, don't worry about any of this. We're monitoring this, but we do get a lot of questions about RMDs, and the ops team specifically is definitely on top of this. Now I'm going to shift gears very quickly because I want to get to Q&A. We're going to talk about something that the entire team here is very proud of. We've got a brand new website redesign. This whole project took us about 9 months from concept to completion, and everyone here at the Wealth Stewards had a hand in it. The goal was, for sure, we want an online billboard talking about what we do for folks, but we also wanted this to be a true client hub, a place you can visit for some insights, for some education, and for some resources. So, when you go to the website, and I encourage everybody, just because we'd love to have your feedback, it's tws.finance. Again, it's tws.finance. You log in there, you see our website. The first thing you see is engaged advisors and evolved portfolios. I hope that working with us, you do get a sense of both of those things. I hope that you feel that the advisor you're working with is deeply engaged. And this year specifically, I hope that you feel that our portfolios have continued to evolve to meet the changing market conditions. And those are two things that we're very, very focused on delivering. And we wanted this to come through in the website. Now, some of the things you can expect to see in this website, Chris, let's see that next slide real quick. So among many other things, we've got a blog that's going to be updated regularly. We've already got about 10 to 12 articles in there. It's ranging from RMDs, similar to what Kayla just discussed here, to business transitions, to you name it. There's a lot of stuff that is already up there, and it's going to be updated regularly with a lot of insights. Also on the podcasting front, those of you who know me know that I've got about 110 episodes of my podcast. You can access that directly on the platforms or through the website. I think what Jeff and I are most excited about is we have something new, and the first episode is going to launch very shortly. We've jointly decided to do a podcast together. It's called Stewards of Success. And it's highlighting people, primarily here in the Valley, who've built remarkable businesses and lived truly successful, well-rounded lives. We've recorded our first episode. We've got a recording that's coming up very soon for the second one. This is going to launch soon. You're going to be able to access this on all the major platforms, Spotify, Apple, Amazon, and of course, you're also going to be able to link through it right through the website. And next slide, Chris. And one thing too is we're not going to dive through every little bit of the website here, but we want to speak to the people that we're serving. At the heart of this is really what we're trying to do is make sure that we're serving all these people very intentionally and in a way that's going to work best for them. First, we love working with entrepreneurs. I mean, the builders, the people that are taking risks, the people driving the economy. And we do offer full cycle consulting as these businesses start, grow, and eventually exit. Many of you that are here tonight, if you're with us, you're financially independent. And our role is to help you protect your time and your freedom and to ensure that your wealth works harder and lasts much longer. Family stewards, that's a big demographic that we serve. And these are really people that have built something special and they want to prioritize having this wealth, having these resources best serve the people around them, and making sure that their loved ones are well taken care of and as secure as possible. And then finally, there's always a tier of people that have much more complex needs. And so we've created Elite Wealth Services. So this is something where there's a coordinated suite of services across investments, estate, tax, insurance, philanthropy, even family governance. It's a very robust platform that we've now built and put together to serve those of you that have the most complex needs. All this is right on the website. Again, we'd love to have your feedback. We spent a lot of energy on it. We hope that it conveys the message of who we are. And so please, I welcome you guys to check it out. And I'd love to hear the comments, good, bad, pro, con, everything. But please give it a look and tell us what you think. And now with that, let's transition it to Q&A. And we want to make sure we get all your questions answered. I got the first one here. Cyrus, I'm going to direct this at you. Brent said SBL and margin. What is the difference between an SBL, securities-based loan, and margin?
Great question. So let me pull my face up here that nobody wants to see. But margin and SBL are both ways to be able to borrow off of your taxable brokerage assets. So first, let's be clear, you cannot use it to borrow off of a retirement account. but both are ways to borrow off of your investment assets. And SBL, or securities based lending, is really just a banking product that is an overlay on a brokerage account that allows you to draw funds from the account up to a certain line amount. Margin is more on a broker side, an investment product that really offers the same thing, where you are able to leverage your portfolio, borrow off of the account. And really what we are looking at is, and both are variable, both adjust with the Fed funds rate. And we actually are able to more or less negotiate rates on behalf of our clients on both. So first, we want to determine where are we getting the best rate. Both can be tracked in different ways, but if you're using the funds for an interest expense, check with your CPA, of course. You may be able to deduct that interest expense on it. I think more it's the tracking of them that are going to be a little bit different, and the nuance of whether it is a banking product or an investment lending product. One key difference is you hear a lot of margin as investors are buying stock on margin to leverage their portfolio to try to participate in bull markets. And that can add a lot of volatility in markets. If we see a correction, people have to sell out of stock to cover their margin. Whereas securities-based lending is a sole lending product. You're not able to use it to buy more stock. So while margin is more commonly used for leveraging, margin can still be used to borrow off of the portfolio for shorter term bridge financing type needs. And at the end of the day, we want to just make sure that we are getting you the best rate and the most appropriate lending vehicle that works for you. But when we say margin, what we don't want you to think is the Wealth Stewards are trying to leverage me up and take extra risk. That's not the case. It's more just another vehicle for lending.
Thanks, Cyrus. We got another question. I'm going to direct this one to Ryan. It says, are Treasury inflation protected securities still a thing?
I am still here. Yeah, they are still a thing. So Treasury tips, inflation protected. So these have actually performed really well as we went through this bout of inflation. One of the better places you could have hidden out in fixed income markets. I think the general expectation is, yes, we have had a temporary resurgence of inflation on a much more minor scale lately. I don't think we're expecting inflation to cook up again. Now, there's things that could happen where that changes, but I don't think that's really where we would be focusing at this point. I think there's better places that you could be putting money to work in bond markets right now. But yeah, that was one of the best places you could have been in 2022 and 2023.
Okay. And I want to say first, thanks. We have amazing, wonderful clients, because literally every single one of us has poured through every link in the website to make sure it all works in the last week since we launched it. And one of you on the chat has already found one link that's not working. So again, thank you for, and we want to see this stuff because there's a lot of stuff on here. We want to make sure these linkages all work. So thank you to the guest here that showed us that one link that's not working properly. Here's a great question, and I'll tackle this one. It says, are portfolios designed to endure a deep correction? Valuations appear to be stretched. Markets have gone straight up on the back of a handful of stocks, similar to 2000. At some point, there will be a reversion to the mean. Yeah, yes, and actually, you're bringing up a great point. There's a lot here. I'm going to start with, you talk about this concentration, this concentration of stocks. If you're buying just the S&P 500 right now, basically what you're buying is a highly convicted portfolio of a couple stock names. And what I mean by that is the top 10 stocks that comprise the S&P 500 are over 40% of the value of the S&P 500. So what that means is you are highly levered to what some of these companies are doing and how they're performing. And we've never seen that level of concentration. So what you see with our portfolios is our large cap core piece that we have in there is significantly smaller, I would argue, than most of the other folks that some of our competitors that might be out there. In terms of portfolios being designed to endure a deep correction, the answer to that is also yes. And so this has been kind of a reoccurring theme in the past year or so, but I'll bring it up again and kind of hit it in a little shorter of an explanation. But when we all came together, it was very important to us that we are all running and driving towards the same investment philosophy. And so to that end, what we did is we interviewed a number of different firms, and we wanted to hire an external CIO, so an external chief investment officer, one that would still give us 100% authorship of our portfolios, but that we could check our ideas and opinions against. We landed on a company. This is the massive project for Q3 into Q4 for us. Called Fiducian Advisors out of Chicago. Brief update on them. They run about $200 billion of institutional family office money themselves. They advise RIAs like us to the tune of about another 400 billion. So they've got their fingers in maybe 600 billion worth of allocations. The main reason that we went with them is I think that there's been, and it's not an intentional flaw, but there's a flaw in our business where there's this expectation that you're going to get normal returns, and history has proven that's not the case. It's to get wonky on you. The normal curve has a big fat negative tail, so there's a big negative skew. And what I mean by that is there's the frequency and the likelihood of big downside markets. It happens more often than most people model for. An example I've always used is back in 2008. I recall Goldman Sachs analyst saying that what was occurring in the financial market shouldn't occur in the lifetime of 5 universes or something ridiculous. But the answer is it did. And we also had COVID where we went down 38% in a straight line. We had Liberation Day this year, we went down 15-20% in a straight line. So those events happen far more frequently. And so one of the things that Fiducian does for us is their risk profiling system. When we dump all of this stuff in there, aside from manager due diligence, they're running multiple scenarios, I think, in a very intentional way, looking at what that downside means. What it's meant for us is a much larger allocation towards alternative asset classes and real estate. We went from being maybe a couple percent allocated to target as a minimum of 15% in alternative asset classes and real estate. Most of these are event-driven hedge funds. They're funds that tend to thrive on volatility. They're looking for price discrepancies. There's some metals in these funds as well, some real assets, because these assets tend to act differently when things get a little weird. And you saw that again stress tested this year. When Liberation Day happened, the NASDAQ went down 20% in a straight line. Our alt sleeve actually stayed positive through that event, and it was a really, really good buffer for our portfolio. So to your point, yes, I think you're going to see some reversion to the mean, which is one of the reasons why we pulled a lot of allocation out of U.S. stocks, specifically U.S. large cap. And we are absolutely very intentionally designing these portfolios to withstand more extreme market events. So that's a great point. So thank you for that. One more question. This one's for Kayla here. Kayla, so it says, yes, and I'll answer this, but I will let her answer. You will make sure that my RMD is completely taken before the end of the year. Is there any way that you could miss it?
No, we for sure will not miss your R&D, and we will be almost harassing you if you do not take it before December 31st. So we will not miss it. If you have not heard from us yet, good chance is you're already complete.
Got another question. We can all touch on this, but I'll touch on it first because it's actually on the wall of our building. It says, will you please restate your mission as TWS as the Wealth Stewards and discuss how you stand by it now as opposed to the time when you created it? It'd be a comfort to hear it during this era of political chaos. Thank you. Yeah, we're driven by really 4 core values here. One is an optimistic worldview, which I do understand that pretty much as long as in the last couple decades, I would say for me anyway, since 9/11, there's been a lot more chaos in the world and a lot more unknowns than perhaps than we knew of, at least when I was growing up in the 1970s, 80s, and 90s. Some of that's a byproduct of the fact that we just have a greater degree of information than we ever have, but some of it's real uncertainty and this feeling that things are changing a little bit. But first and foremost, in here at the Wealth Stewards, we're guided by this optimistic worldview. Second is we believe in the nobility of our profession. Again, these values are on our wall when you come into our office. We believe that what we do is extremely important to all of our clients' lives, and we take very seriously that responsibility. Third value that we have is we're dedicated to continuous improvement. Everyone in here, Ryan just got a tax certification, which he can share with you, and he definitely should, but a tax certification that very few people have. And that's just him on his own out there wanting to go do this to expand his capability set so we can deliver a better experience to our clients. And fourth core value we have is we believe that discipline is freedom. And that's the more that you can put some structure and some guardrails around things that you're doing, kind of the greater freedom it gives you to operate within that, which is why, we're very intentional about how we build our portfolios. We don't just have whatever the hot idea is that people are talking about. We throw it in there because we think it might make sense. You have to have some discipline in all areas of your life, but specifically around money. And all of our processes, all of our systems, and all the way that we interact with our clients is really built around that. Actual mission statement, it's the Wealth Stewards is centered around an empathetic and disciplined approach to shared achievement. One of the great things we love about this business is that we are on this journey with our clients, and it's an amazing gift to be able to walk through this life with you. So thank you for that. And it's also through a strategic, collaborative process and unparalleled ongoing care, we aim to transform the financial trajectory of those we serve. So that's our mission statement. I think I followed up with a bit of our values, but anyone else want to chime in on that? Because it really does truly guide everything that we do here. Anyone?
Yeah,
Ryan, I'm going to put you on the spot first to talk
I
about
was
the
going to
tax
jump in. Yeah.
certification that you got.
Yeah, I mean that aside, I mean I think this is a great question, and something that's good for our clients to know. We all have a different background, and we come together, and political climate can really be divisive, and so I think it's good to have open lines of communication and differences of opinions, and us being able to still come together, have a conversation. I do think the political climate can create challenges in certain areas, but in terms of the portfolios, the nice thing is it typically doesn't matter who's in office as it relates at least to your portfolios. There's other issues in the world that we can't control, but it's good to be grounded and know regardless of what's going on, we're keeping an eye on this, and there is historical data that we can reference back to. So I do think that's just comforting for people to know that we're looking at and considering these things regardless of which administration's in office. In terms of tax planning, less exciting, but yeah, spent a number of hours in taking exams to be in a position to better help our clients with more advanced tax planning issues because uh, circles right back to the government. Most of us don't love giving the government money if we don't have to. So I am working hard to let you keep more of those dollars and give less to the government.
And what is the certification, Ryan? What did you just get?
Yeah, it's the TPCP, Tax Planning Certified Professional.
Great.
So it's a deep dive in all aspects of tax planning, whether that's for business owners, individuals, ultra high net worth clients, and so on.
Yeah. Now, I'm going to invite anybody, if you have any questions, we got a couple minutes. We're going to do a hard stop here in about 3 minutes or so. I'm going to tag onto that a little bit in terms of this level of uncertainty. So I'm a deep history buff, and I read a ton of history. I absolutely love it and adore it. And I think it's illustrative in terms of that history doesn't repeat itself, but it rhymes. I think it was Mark Twain that said that. But if you actually go back and you read through history, as chaotic as things may feel like and seem like they are right now, there really has not been a time in human history where it hasn't been somewhat chaotic. And I even look at, my parents going to school in the 1950s, doing a duck and cover underneath their desk because they were worried about the world being annihilated, as if that little tiny desk was actually going to save them in that regard. So I think some of it might feel more chaotic right now. I think because I do think that everything now is geared toward the clicks. It's geared toward the media. You're not having the Lincoln Douglas debates where they're going back and forth for 2 hours discussing real policy. They want that 10-second, 30-second soundbite where they can say something that's going to get them on the news. And I think that unfortunately it's kind of distorted our political system a little bit. But I also would say that if you look at the driver, and it's very relevant to what we do in here, the growth driver, the engine that drives this economy, I would argue, is as robust as it's ever been. The innovation, the creativity, the ability of the American people across the board to continue to come up with new ideas and products and services. It's unparalleled anywhere in the world, and I do believe that's going to continue, for a long period of time. And we're blessed because we're able to invest in these products and services and people and individuals. So I'm optimistic. It's one of our worldviews, but I truly believe it at my core. Any other questions before we sign off here? All right, with that, we want to be very respectful of your time. If there's anything that we did not cover, you can reach out to any of us individually. We'll make sure that we answer you. I want to thank you all for the time that you spent with us here already. Please go to our website because we found one thing already that we need to go back and fix. So we encourage you all to do that. And with that, we will be doing this again in the beginning of 2026. But until then, have a wonderful holiday season and really want to thank all of you for joining us. Take care, everybody.
Thank you, everyone.
Thank you all.